Good morning, everyone. Thank you so much for joining us today morning for this month PentaTalk series. I hope you and your loved ones are in good health and doing well in this challenging time. We have seen the pendulum swinging from fear of 2020 to optimism in 2021. In fact, our economy was going through a challenging phase post demonetization, GST, RERA, and right when it was on the cusp of revival, it got hit by COVID once again. But as it says, no, every storm runs out of rain. Every storm runs out of rain, just like every dark night turns into day. So we are back with the help of progress in vaccination, government stimulus, government reforms, and now we are trying to accelerate in right direction. Now to gain that pace, to accelerate, government is focusing on infrastructure. It is pushing too hard on the infrastructure side. So I'm very happy to share that today we have two experienced fund managers from the industry with us who have been managing infrastructure fund, and we're going to interact with them to know their views on this particular sector. So on behalf of Pentagraph, I, Meghasham Sinker, welcome Mr. Sanjay Doshi, a fund manager of Nippon India Power and Infrastructure Fund, and Mr. Charanjit Singh, a fund manager of DSP India Tiger Fund. Let me introduce them before we start our conversation. Hi Sanjay, may I request you to wave your hand, please?
Morning, everyone.
So Sanjay is a qualified chartered accountant. He has done his MBA in finance from Narsimunji, Mumbai. He is also CFA chartered holder. He has over 16 years of experience in equity research and fund management. Prior to joining Nippon Life India Asset Management Limited in 2011, he has worked with Macquarie Securities and JP Morgan. Let me introduce our second fund manager today. Hi Charanjit, may I request you to wave your hand, please?
Hi, good morning, everyone.
So Charanjit is an engineer with MBA in finance. He has total work experience of 16 years. Prior to joining DSP Asset Management Company, he has worked with various organizations like B&K Securities, Axis Capital, BNB Paribas Securities, HSBC, IDFC Corp. So Sanjay and Charanjit, welcome once again to our PentaTalk series. We have our in-house research at our Pentagraph, where we give allocation to sectors based on their future expected growth. And recently we have added infrastructure to our model portfolio. So we would like to have your view on this sectors. So I'm going to ask a few questions to each one of you. After our conversation, we'll open the forum to the participant for Q&A. So meanwhile, I request everyone to stay on mute till then. Sanjay, here's the first question for you. What is broadly covered when we talk about infrastructure as a sector, as a theme?
Right. Thanks, Meghasham. Good morning again to all, and good morning to Charanjit and the team at Pentagraph and all the investors. So as you tried to highlight, what do we mean when we look at infrastructure as a theme? So when we look at it as an economy, I would say that so infrastructure basically would, I think there was some echo. Is anybody getting?
There's some echo.
Sanjay, properly. We can hear you.
Yeah, fine. So basically what I was trying to tell is that when we look at an economy and when we talk about infrastructure, I think it basically means the systems, the assets, the services which are absolutely essential to run the economy or to grow, to improve productivity and efficiencies. So it's just not the physical infrastructure that we know, like the road network or the railway network or the power network, but it also includes your economic infrastructure, the industries which are involved in the economy. It would involve your social infrastructure, which is the healthcare and educational institutions and the infrastructure related to that. And now also more importantly, the digital infrastructure that most economy are moving towards, right? And when we look at an infrastructure theme fund or a product, I think what we try to do is, sorry, we would look at investing in companies which are totally involved in these activities, which is basically the development of infrastructure, the operations and maintenance of these infrastructures in whichever form they are. So if I have to clearly highlight some of the basic areas that most of these infrastructure funds will have investment, it would be your transport infrastructure, which is railways, roadways, ports, airports, aviation. You would have your power networks or power infrastructure. It would include your housing or the commercial real estate. You will have telecom or digital infrastructure. You will have various industries like defense, oil and gas, metals, cement. As I mentioned, social infrastructure is also an important part of an economy. So healthcare and educational infrastructure. You would have industrial engineering companies, which are a key component of development of these infrastructure and construction companies. So these are some of the broader areas that an infrastructure fund would like to invest.
Thanks, Sanjay. Charanjit, ये सब जो चीजें हैं ये तो बहुत important है. Then why this particular category, why this infra fund delivered comparatively lower return over last 10 years? और ऐसा क्या change हुआ है in last few years which makes this sector attractive? Would like to know from you.
Okay. Thanks, Meg, for this opportunity, and thanks everybody for joining in for this session. So I think Sanjay set a very good context in terms of defining this sector. Now, मैं क्या करना चाहूँगा पहले historical perspective क्या है infrastructure का? That's the most important thing. Where we are in the cycle. पिछले 10 साल 15 साल में क्या mistakes हुई, and are those mistakes now rectified to lead us to a pickup in the investment cycle? That's the biggest question which we are going to answer here. And once you have that answer, then it becomes easier for any investor to look at infrastructure as a theme. India as a country has gone through the super capex cycle over 2003 to 2007. What happened at that time? At that point of time, the global commodity boom was there. India was going through a major reform process where we did major reforms in the power sector, where we brought in Electricity Act and privatized the power sector capacity additions. At the same time, government was also pushing on the capex. And from there, we saw big capex cycle starting. And a lot of private sector companies started investing in large capex intensive sectors, which are power, steel, and cement. So there was a lot of liquidity available. As government brought in reforms in the power sector, what we saw is from 5 gigawatt, we started adding almost 20 gigawatt of annual capacity additions. So आपका वो capacity addition बहुत बढ़ गया उस sectors में. And real estate, which is another engine of growth, that was also firing. So all three engines of growth, private, government, and real estate were firing at the same time during the last super capex cycle of 2003 to 2007. But what happened? 2009, when the global financial crisis struck us, at that point of time, the demand collapsed. There was like policy paralysis. And what we also saw is that companies had taken excessive risks, had got excessive leverage on the books. So on one side, your demand collapsed, your leverage actually started hurting them. There was a global slowdown and commodity cycle also started getting impacted. So that is the time when companies who had over leverage on their balance sheets, they started getting impacted. And that painful process continued because 2003 to 2007, we were in the balance sheet expansion mode. Then we got into balance sheet contraction mode. So that is what started happening. When the market is growing, when the infrastructure growth is coming in, companies start taking excessive risk also. So what happens with that? You start getting into newer areas. I'm a road contracting company. I get into power, real estate development, airports, and I'm not able to manage the risk. So 11, 12, what we saw is there were a lot of policy related issues which also came in terms of land acquisition, in terms of financing not available, in terms of receivables getting stuck. So infrastructure as a sector has gone through that learning curve. So what we have done is over the last 10 years, we have learned that what were the issues which we faced in infrastructure, and we don't want to repeat those issues. From 2014 onwards, there were major reforms which are brought in the construction infrastructure space. Government started giving advances for projects, payments started coming on time, and 80% of the land had to be acquired before the project could get ordered out. So that was a big game changer for the entire construction sector. And even recently, there have been a lot of reforms which have been brought in, where government said that 75% of the payment for the projects have to be done in the first 10 days itself. So what we are seeing is that we have gone through that painful phase of learning curve in the infrastructure space. There was a time for the last 10 years, like Meg, you asked a very pertinent question. What happened in the last 10 years? Last 10 years, both the engines of private capex and real estate were dormant. There was no capex happening. Only government capex was there. Government capex was growing by around 12 to 13% CAGR. Private capex, despite private corporates profitability increasing by 1.7x, the capex was flat over the last 10 years. So what we are saying is now the most important question, now why we are highlighting this theme right now, what is changing? So I think we have understood that we have bottomed out in the cycle from investments to GDP perspective. Government understands that investments are very key to drive the economic growth and create jobs. So macro factors which are giving us confidence that the cycle can reverse from here, and this can be a longer cycle. Longer, not just 5-year cycle, maybe longer cycle than what we have seen in the previous capex cycle. One, banks' balance sheet have become much more stronger. The NPAs have come down significantly. In terms of our credit cost, we are at 2 decades low. Government has also cut the tax rates for new manufacturing capacities to 15%. So what I would like to also tell investors is not to paint this infrastructure theme just as a construction theme. This is more broad-based. Like Sanjay rightly mentioned, you are touching digital infrastructure, you are touching, manufacturing capex. So all those come into this theme, which will get played out as we see the macro factors being benefiting this. And finally, government has also done a lot of reforms. Like you rightly said, GST, RERA. We have gone through the painful phase of implementing those reforms, and now it is the time to start benefiting those reforms. So I think clearly investment cycle is bottomed out. From here on, we can see the pickup in investment cycle. Government is backing that by increasing its spending. Corporate balance sheets are deleveraged. And from here on, as the visibility on demand comes in, there'll be a definitely pickup in the cycle. And this cycle is going to be much longer than what we saw in the previous cycle.
Thanks, Charanjit. Main driver जो होता है infrastructure का, so we always say the main driver is government. It's spending in infra space, is investments. So Sanjay, आपको क्या लगता है कि what steps are taken by the government to push this infrastructure? Can you please throw some light on it?
Sure.
You can share the slide also. Anyone, Charanjit and Sanjay, if you want to share slides, please do.
Sure. Thanks for that question. And just like to compliment first on Charanjit. I mean, we rightly pointed out many of the areas which had problems for the space, and many of these are now clearly positive indicators for the sector. Also, just to add one small point is that over the last 10 years, even the markets have evolved. So we have innovative products in the economy today, like InvITs, like REITs, which were not there, which could help you to churn capital, which is very critical for development of new infrastructure. Just to point, and to your question about government, I can't agree more with you that yes, definitely that will be the leading role from the government side. And especially now that the economy has gone through another major shock, which is a COVID pandemic-induced shock. So I'll just share a couple of slides, which hopefully will give some more color about it. Can somebody just confirm it is clearly visible?
Yeah.
Yeah, fine. So on your question about what government has done and why the focus, I think it's important to first understand what even Charanjit highlighted a few minutes back is the intent of the government. I think it is very important to understand that this government has realized the benefits which flow to the economy when you spend on creating long assets, long time assets, which are basically helping you to improve productivity, improve efficiency, and make India a more competitive economy on a global context. At the same time, it has a multiplier effect. When you spend a particular amount on infrastructure creation, it has a multiplier effect on various industries which participate in this creation and maintenance of these infrastructure assets. And at the same time, it has a huge employment generation potential for an economy where there's so much of population coming into working class. That clearly should be another focus area to get right employment generation, which also was put forward by Charanjit. So it is very clear that this government acknowledges the importance of creating long infrastructure and improving the competitive positioning of the economy. Now, the biggest proof of that was what we saw in the year when the economy went through the major shock, which nobody would have imagined. I mean, an economy which is shut for 3 months, total economy shut for 3 months in response to COVID. So when we had the pandemic hit us and when we saw the kind of measures the government took as a precautionary measure to ensure we don't have much loss of life and livelihoods, it was very clear that everybody expected government spending to be hit, and especially areas like infrastructure, because you have to create more resources for health infrastructure. We have to spend more on those areas. But to everybody's surprise, actually the amount never fell. So the economy did contract a bit, but the government spending overall did not go down. I mean, we were looking at probably the lows of 4.5 as a combined spending of governments in terms of the GDP spend. But we actually saw a kind of a flattish number for the last fiscal, and now we are seeing an improvement which is in line with what the government wants to do over the next 4 5 years based upon major reforms which they have undertaken. So I will come to that part, but it is important to understand the intent of the government for this space. As you highlighted, I mean, if we want to touch base upon a few reforms which are critical for this space from the government side, there's no doubt that government spending will lead the cycle. And I think we're already into a decent phase of the cycle. Benefits are being flowing to other participants, including state and private. But the first part about the major reforms, I think the economic reforms which have been seen over the last 4 years, including the goods and service tax, the insolvency acts, the RERA, the labor reforms, basically the formalization of the economy. That itself is a very important criteria. It helps you to improve the tax collection for the government. And at the same time, it improves the positioning of the economy and therefore attract global capital. So that is a basic area on a economic front, the reforms, how they are helping us. Now, looking at infrastructure as a focus area for the government, I think there are very key important steps which the government have taken, and I highlight a few of them. First and foremost, the national infrastructure pipeline, the blueprint which the government has given out from a long-term standing. I mean, the numbers are mind-boggling, and we have to remember it's a Modi-led government, so it will always be beyond what one could imagine. But it's 111 lakh crores kind of spend over 4 5 years, which is more than double of what the economy has spent over the last 4 5 years, the space. So it's that kind of a ambitious plan, and I think we are having our doubts, but we are on course to achieve most part of it. What this also gives you, the NIP, it gives you a clear roadmap of what the government wants to do with the economy, the key focus area. Not to forget, the economy is also transiting into many areas like moving away from traditional coal-based assets to more renewable, transition from an oil-based economy to a digital change which are happening. So all these are very clearly highlighted in the roadmap the NIP brings out, which helps everybody. I mean, the central government, the state government, the ministries, the private players, they know very clearly where we can participate in the opportunity. So that is a very clear roadmap from the government side. Second is the initiative on Gati Shakti, which is trying to coordinate better. These projects are multi-year projects. They involve so many states. It includes so many ministries. and there's been a history of delays in projects, and that is where if you have a very coordinated logistical approach across all infrastructure projects, I think that will help to improve your implementation, and that is where Gati Shakti comes in. So all the logistical related infrastructure projects where we want to save almost 7% of cost on an economic perspective, I think that will be very important step on the coordination part of it. The next obvious question is about the funding for these large spendings. I think here also a series of steps have been taken, and there is important to understand the change in thought process of the government here also. First and foremost, we have taken a fiscal leeway. Obviously, the pandemic has thrown new challenges, and there has been impact across the globe in terms of economic contraction and how one should be able to come out of it. And we have taken a right step of taking fiscal leeway for another 4-5 years. It's not a 1 year journey. And here the spending can add almost 1 to 2% of GDP, which can be levered for the infrastructure spending. So that is an important criteria. The other is the national monetization pipeline, which to my mind is a very differentiated thought process, which is nothing but churning the capital which is there in all existing good infrastructure projects from the government side. That is what most private players will also do. Once you take the risk and develop something new, and it is fully operational with clear framework, you are better to move out and take more risk capital. But for that, you need to churn it. And I think that's the clear mandate from the national monetization pipeline, that government recognizes that you need to free up the assets on the large infrastructure which are already there. And that will go a long way. I mean, the kind of targets that are also quite humongous, but I think it is a matter of time that we'll achieve them, almost 6 lakh crores. Then there's a developmental financial institution, which is a dedicated institution to leverage government equity. We have also done a lot of reforms to get foreign funds. There are a lot of market developments and a lot of benefits being given to long generation sovereign funds, pension funds, and infrastructure asset owners. As Charanjit was highlighting, what happened in the past cycle is that people were stuck with their capital. You were not able to utilize in a meaningful way or release those capital. Now, this is where the problem happens is the one who has invested in a creation of a long asset of say 20, 25, 30 years, he doesn't have the same time period of holding. And that is where once those risks are taken of creating an asset, you bring in the people who require long generation yield assets, which are the sovereign funds and pension funds and infrastructure asset owners. So we have tried a lot to get those capital, and there's n number of deals which have happened in the last 1 year, whether you look at road assets or power assets or airports in India. So that is a right step, getting the right global capital at a time where liquidity is very strong and the rates are very favorable. The government has also taken a step of development of a bad bank. Like Charanjit again highlighted, there was a lot of insolvency issues. Now, if those assets are not being resolved in a timely manner, the incentive for new development also goes down. This is where a bad bank can come in and try to help resolve those issues. From the private side, there are very important steps to incentivize spending from the government side. Tax cut, as Charanjit again highlighted, there's a flat 10% cut for the corporates, and then there's additional tax benefit for new assets. So those kind of direct money coming into private side. And more importantly, now the production link incentives. That is, to my mind, the best step to incentivize private investment. We saw the success in mobiles, where India not only reduced imports, which was one of the biggest component of imports after, say, oil and gold, but we also started to export mobiles. And now the kind of benefits the government has given across new technology areas, across the existing infrastructure, whether it is pharmaceutical, chemical, specialty, cell manufacturing, you want fabs, the kind of benefits their government is rolling out, it's quite meaningful, almost like 1.5 to 2 lakh crores. And here it is very clear, it is not based on intent. You need to produce, you need to get the output, which will help us to reduce the import, or we become an exporting country. And that is where the government steps in and gives you a subsidy of almost 6-7% of the cost. So that is a very meaningful incentive from the government, and this will let private capex for at least next 3-4 years. Last one thing I want to highlight is on the government side is the defense part of it, the reforms which are happened from the government on the area. There's a clear focus of having more indigenous contents. We are one of the largest importer of defense equipment, and given the kind of uh, importance this particular area has, the kind of geographical position the country is, I think it's a step in the right direction. We cannot depend on global technologies. There is significant reforms done in terms of what we can import and what we cannot. There are proper funds being available through the Modernization Fund for Defense and Internal Security directly from the central government side. And we have developed capabilities which now people are looking at from the export angle. So some of the platforms are now not only accepted by our armed forces, but even our friendly neighbors are looking at those. So these are some of the key, I would highlight 6, 7 reforms from the government side, which to my mind will go a long way in supporting the cycle.
Thanks, Sanjay. Wonderfully covered all the steps taken by the government. Charanjit, Sanjay has already covered the steps taken by the government and the infrastructure push from the government side. Do you see any capex coming from private sector apart from the government? And what are the new themes emerging for this private capex? The new themes. Would you like to throw some light on this, Charanjit?
Yeah. Thanks, Meg. I'll just share my screen. Can you see the screen now? Okay. So what is happening in any capital cycle? What we see is that it's the government who starts the capital cycle by starting to invest. Sanjay has clearly highlighted that government's intent, government's policies and reforms all are aligned towards that pickup in investment spending, and the numbers are definitely mind-boggling. So what will happen is in this capital cycle also, government starts that push. We have already seen that push in FY22, where there was a 26% increase in the budgeted spending on capex by the central government. Budget is going to be announced now in Feb. There's again expectation that infrastructure should take the lead and should see a very strong growth in the spending going forward also, because that's the only way we can grow our GDP and create jobs. Now, if that happens, so private sector will definitely see that the demand is going to improve. As my demand improves, my visibility improves, because private sector wants returns. Right now, when we look at the capacity utilization data, which you look at the chart here, it is showing 69-70% capacity utilization. While you may say that at 70%, nobody is going to invest, they want a higher capacity utilization. But what happens is that as your demand visibility is increasing with the government capex picking up, you have to start planning right now. A cement plant, a steel plant could take 3 to 5 years to come on stream. As our demand starts picking up, you cannot just go ahead and start ordering these larger plants at the point of time when the demand has already overshot and you don't have enough capacity to meet that demand. So that is where all these companies, they start announcing capex despite the capacity utilization being low, because government is giving a clear indication in terms of increased spending in the construction space, roads, railways, and all the other key segments. So what we are seeing is that the lead indicator in terms of announcement has started to pick up. What we are seeing is that if you look at the private sector, these are the key areas where the capex will pick up. While cement and steel are the core sectors, we cannot neglect them, and they will be the core in terms of the spending, because the large amount of spending which is there. If you look at the metals companies have seen a significant deleveraging of their balance sheets. And now looking forward to, they have already announced 25 to 30 million tons of capacities to be added. Similarly, cement, what we are seeing is that because of the infrastructure demand growth picking up, the volume growth is expected to remain strong. And there again, what we have seen is 75 million tons of capacity additions, which have been planned in the cement sector. Now, apart from these core sectors, what we see is in every cycle, there are new drivers of capex also which emerge. That's where your portfolios have to be aligned. That's where you have to look at the companies which are aligned to these new drivers of capex. So what are these new drivers of capex? So digitalization and automation is one important theme, which is playing out globally and also picking up in India. And I'll give you an example. What has happened is, because of COVID, this theme has got accelerated. A lot of plants, they suffered because their plants were not automated or they could not manage it remotely. The plants had to be shut down because of COVID. Now people have realized the importance of digitalization and automating their plant. And that is where you are seeing that this trend is picking up and there are very few companies which can cater to this demand. Another important factor which is leading to this is as customers, we have become more demanding. Every season, there is a new product, new auto model which is coming out, new fans models which are coming out. So you cannot have a manufacturing process which is not automated, which cannot cater to this rising changes in the demand. So that is where the automation has to come in, and you have to digitalize your plants to actually be the faster to roll out the products in the market. Next new driver is data centers. Now, why data centers? Now, these are, so as individuals, as corporates, as government, we are generating humongous amount of data, which we have never generated in the history. So what these data centers are doing is they are going to store that data. Government has already brought in a regulation, which is going to say that any data which is generated in India cannot be stored in the outside locations. That is what is fueling to this demand in data centers. And by FY26, we are seeing that this capacity can, or the demand can become 5x. May, can you put everybody on mute? I think there's some background noise. Yeah. So data centers, if you look at 30% of the cost of data centers is power equipment, 15% is automation. Then you require cooling. So that's the kind of scale up which is happening in this new driver of Capex, which is being done by the real estate companies, by large private tech companies. And this is going to significantly pick up in this cycle. Sanjay touched about this performance linked incentives. I just go deeper into this as it is linked to the private Capex in a bigger way. Now, performance linked incentive is the biggest moment in India's history to become a manufacturing hub for the world. And why is that so? Why performance linked incentive scheme was brought in? US-China trade wars, when they started, at that point of time, companies thought of having a new supply chain partner because they were seeing that sourcing from China would become difficult. Then COVID came and there were so many supply chain disruptions that a lot of companies were not able to manage those supply chain disruptions. And as that happened, India as a country stepped up. India realized that they can become manufacturing hub or factory to the world. Government brought in performance linked incentives where they said that 5 to 6% as revenue generated will be given to you as an incentive. And first the mobile phone PLI was brought in, and now it has been expanded to almost around 14 sectors, and another one which will come is for hydrogen in the future. So what we are trying to do is scale up capacities in India for domestic manufacturing and then use those world-class facilities to touch base or to cater to the export markets. For this, government has already come up with an incentive of 2.6 lakh crores. So that's government incentive over 5 years. But for that, the private companies, they are going to invest 2.4 lakh crores over the next 3 to 5 years time frame to build up those capacities. So this is what is manufacturing-led Capex. This is what is giving us longer-term visibility on the private Capex, and this is a committed Capex. Another data point which I would like to give you is government called for solar PV module bids, and the bids requirement was for 10 gigawatt. कि अब 10 gigawatt की bids के लिए हमें solar module manufacturing के लिए companies चाहिए. What came was for 55 gigawatt bids came in. That is the kind of interest which is there from players for solar module manufacturing. So जो आपका 4,500 crore का PLI which was planned, now it is being scaled up to more than 20,000 crores. So that's the kind of demand. So PLI is definitely a success with the private parties who are very keen to invest in, and this is what is driving the manufacturing Capex pickup in the Indian context. Then is the renewable energy. Like I had earlier told, last cycle was driven by power sector Capex picking up. Power sector Capex is coming back, though in a different way, not coal-based generation capacity, but renewable, solar, wind. Ye sabki jo capacities are, these will come on stream. And we have kept a very big target. Now this has been revised to around 500 gigawatt by 2030. And right now we have only around 100 gigawatt of renewable capacity installed base. So what we see is that over the next couple of years, there's a continuous ramp up which will happen for the renewable capacity. And another important point to understand is this renewable capacity is required for us because we are talking about electric vehicles, we are talking about green hydrogen, जो सब के लिए renewables will act as an input. Then definitely electric vehicles. This ecosystem is coming up. For electric vehicles, will require power transmission infrastructure. आपको charging infrastructure चाहिए होगा. So all those things are the key drivers for the private capex, which is going to come up in this cycle. And these are very new drivers for the capex. So that's the second engine. Sanjay had touched on a very important engine of government capex. Second engine is private capex. Third engine is real estate capex. So what we are seeing is that real estate market is again making a comeback after a very long time, because real estate tends to be very deep cyclical. And real estate, what we are seeing is that the traction is not only coming in tier 1, but tier 2, tier 3 across the markets. What we are seeing is that the sales are picking up. Inventories are now touching at almost around 8-year lows from where the earlier cycle had started, and new launches are going to pick up. So real estate as a segment has a multiplier impact, because real estate में आपका building material जाता है, like you can see in this slide, cement, plywood, pipes, tiles. You also have cables and wires. You have paints going in, consumer electricals and consumer durables. So what happens is that this segment drives multiple sectors, and what we are saying is that these other sectors which are dependent on real estate, they don't have only one real estate sector as a demand driver, but they also have a lot of other demand drivers, be it deeper penetration as we are going into tier 2, tier 3 and rural for a lot of these product categories, increasing per capita consumption, premiumization in these segments. So that gives us more sticky, more durable growth in these segments, led not only by real estate, but also by other, very strong underlying growth factors which are driving the demand for these multiple subsectors. So that is where we are getting the comfort that these two engines of growth, they are seeing a good comeback. There is a commitment from government. Private balance sheets are much more stronger. So they are just waiting for the demand recovery to come in and go ahead and start doing the capex. So in next 1 year time frame, our thought process is that this private capex should start picking up in a meaningful way. First, we'll see big announcements coming from the government side, and that is how this entire cycle will pan out.
Wow, Charanjit, superb. This is really interesting and emerging areas over these traditional areas of infrastructures. It feels like, we're really proud of now Indians, the kind of sectors which we are driving in terms of infrastructures. Thanks for sharing such a wonderful idea on the private capex. Sanjay, if all we are talking very good, and but there is still one risk. So, आपको क्या लगता है? Which are the top 2 risks to this sector to not perform as per our expectation? What can go wrong? Just top 2. I just wanted to know top 2 risks for this sector.
Sure. Yeah, it's good to know the other side, the caution part of it. Not to forget, it's quite a cyclical space, so there is volatility. I think the top 2 risks to my mind, first to begin with, could be on the government side itself. We can't underappreciate the importance of government reforms and spending. If there is any political or geopolitical issues, that could be a very big risk in terms of at least hiccups in terms of the overall spending. Luckily for us, we have a very strong mandate at the central government, and which is there for another 3 years. We have not seen these kind of mandates given by people, and that probably reduces the risk to some extent. But yeah, anything on the political or geopolitical will be top of my mind in terms of what can go wrong. Second, as we are looking at new investment, I think what drives this investment is also consumption. As an economy, if we start to see very significant slowdown on consumption, it could be because of many reasons, including COVID shock, which could have impacted economy or livelihoods for many people. And if there is a very sharp consumption slowdown, which again will be very mindful, government will be very mindful of these aspects, because this consumption slowdown will mean utilization doesn't move up or the demand outlook doesn't improve, and therefore your new investment goes on a halt. So these, to my mind, will be the top 2 risks from a investment cycle perspective.
Thanks, Sanjay. चरणजीत, if I were to ask you, आपके हिसाब से इसके अलावा कोई top risk हो सकती है? Do you see any other risk to this particular sectors to not perform as per the expectation?
Yeah, Megha, I think the most important risks definitely Sanjay covered, because what we are talking about government as a key driver first, and then everybody follows. But then, definitely implementation of these schemes, what government has launched, proper implementation is going to be very critical. Because what we are seeing is key when you are talking about PLI scheme, when you are talking about the other sectors, a lot of investments are also going to come from the international players, making it easier for them to come into India, do the business, and giving them the incentives as has been planned. That is going to be the very critical factor for the success and for us projecting India as a factory to the world. So that's one thing in terms of proper implementation of all these schemes and policies. Next is in terms of the technology changes. Now, this is an important thing. And what we have seen over the last 15 years, 20 years data, the change in the market has become very fast. In our lifespans as individuals, what you used to see earlier changes coming in 15 years, 10 years, now it is happening in 5 years time frame. The cycles are becoming shorter. So you need to have companies who have that kind of a strong foundation to be able to catch up with these changes in technologies. That's why I'm saying that infrastructure, just don't look at it as a construction sector. You have very good manufacturing companies. You have large ecosystem of manufacturing, which is getting, built up in Indian context. But there are also very big tectonic shifts, big changes which are happening. Coal, say we are moving to renewables. We are talking about automation in a big way. So all these things require a lot of technology, and this technology is changing on a very rapid pace. So whether Indian companies, whether some of these companies which will be in your portfolios, they are able to manage this shift, that will be the most critical factor, or whether they are actually winners of that shift in technology, that's another thought process which you should always have. And that will be the key success factor when you are picking right, sectors and companies going forward.
Thanks, Charanjit. It was really an insightful conversation from both of you. I would like to open this forum to the participant for a Q&A. I request anyone has any question, please unmute yourself and you can ask the question directly. You can please specify whom you would like to ask so that it is easier for them to address your questions.
Charanjit, hi, this is Rahul Mone from Pentagraph.
Hi, Rahul.
Hi, I would like to ask you 2-3 questions. One is considering all these data points which we have discussed now, we already have given as a company call for the investment in the infrastructure sector. So what is the investment horizon you think we should be invested in? For how long we should be invested in this sector? Because getting in is very easy, but getting out also should be critical for the investors. And if a customer wants to invest, whether we should advise them to go for the bulk investment or it should be in the stagger manner. That is number 2. And the last question is there any correlation between the infrastructure sector and the inflation? That is my last question.
Okay. I think very valid questions, and from investors' perspective, these are very important. So let us the first question, first. So what we have discussed till now is where we are in the cycle and how long this cycle is going to be. As an investor, when you are looking at this, investment strategy of thematic fund of infrastructure, manufacturing oriented, once you have an understanding that this cycle is going to be a little longer, 5 years, 8 years. So you should have an investment horizon of at least 3 to 5 years. You keep it for 3 years, revisit it, how the things are panning out, and then take a call whether you want to extend it for 5 years. That's a very simple thought process. Data points are clearly showing that this cycle could be longer. There is no dearth of capital. I'll again say that there's no dearth of capital for India to go ahead and build this infrastructure, to build these assets. We have come up the learning curve. We have improved a lot as a country. And that is where the confidence is pretty high for the private sector, for the government to go ahead and invest. So 3 to 5 years is the investment horizon. Another important thing is whether you go lump sum or you go in a staggered way. I myself follow in terms of staggered investing in the fund. So I also invest in or co-invest in the Tiger fund. So I do a regular monthly SIP into the fund, because that gives me, entry points which are at different price points, plus different segments in the market or in the fund will also play out at different times. So that helps you, capture across the, as the investment journey is picking up. So I think that's the best way to diversify your risk and to manage your returns better. Lastly, being a thematic fund, you should have a kind of, what is the kind of allocation you should have? So what it should be, maybe 10 to 15% of your portfolio you can have in the thematic funds. That's the maximum which you should do in order to manage the overall portfolio risk which you are managing. So that's the answer to your second question. Now, the third question is on the inflation part. So I know there's a worry on the inflation side, but if you look at inflation in the last couple of months, also it has picked up because of the supply side worries. Now, what is the outlook on the inflation? One, the supply side worries are going to recede by the second half. A lot of supply side will normalize. We are having an issue in terms of freights availability. Freight rates have gone up significantly. As supply chains get normalized, COVID shocks come out, we'll start seeing that supply side getting normalized. Another thing what also happened is that there was a lot of money which was there in the developed markets, which led to a significant demand pickup for a lot of products, which suddenly led to a demand shock. There was a significant increase in the demand, and again, which led to increase in the prices. What we are seeing is that again will start cooling off, and inflation as such will start having a better trajectory rather than on an upward trajectory. Another important point to notice that when you are building these assets for the, what government is planning, what private sector is planning, they are looking at a horizon of 15 years, 20 years to build these assets. So immediate inflation can just, push out their plans by maybe 6 months or 9 months, but it is not going to derail this entire journey of building this entire infrastructure. So again, I'm saying it may just push out the timing, but it is not going to derail it. Because these companies, when they see that the demand environment is going to be very strong, and there are factors, I'll give you examples where it is not an option. We have to add that capex. Ab data centers ka capex is not an option. It has to be done because the amount of data which is generated by a bank, by a government, the discoms are getting privatized. Each discom is throwing so much data from the smart meters that the data centers are not able to handle. Every year it is growing. So this is not an option. Spending on water is not an option, not driven by inflation, because we have not invested as a country for 15, 20 years on water. It has to be spent. It will just be timing factor, but it will come. Yeah. Hope that answers your question, sir.
Yeah, thanks, Charanjit.
Good morning. My question to Mr. Sanjay. See, if you really look at the major spending is from the government side. Government's role is, it's like a lion's share, and entire, infrastructure, 80%, if you take even by proportion wise, 80% will be led by government. And maybe, of course, then that becomes an enabler for private sector also to get into, chip into and all that, and get into various initiatives. Now, the thing is that there are, see, when you take about 80%, the major risk is lying with the government. If the government is stable, it's fine. If there are some issues like pandemic coming in between, then again, it can, create some turbulence and all that. So, and the third one, which is most important, is even everything is right, if the proper implementation is not there, or the things are not really translated on the ground, then also there could be a big risk. And the entire investment, whether it is that 20% chunk we are talking about, or the investment which is secondary, tertiary in nature, that entire thing comes to a roadblock. Now, how we really see that long-term investment can be really, mitigated from all this type of associated risks?
Sure. Thanks, Dilip, for your question. I think fairly valid point in terms of the dependence on government. But just to give some more color on it, within the NIP, there is a significant role of private also, which has been clearly defined. So the central and state put together would be less than 70%, and almost 30-35% is coming in from private in terms of the contribution. As far as the government side is concerned, I think what is important to note is the blueprints which have been provided by the government over a longer period of time through the NIP. So it's not a haphazard thing, which is like we will do this 1 year and we will see what to do next year. So that is very clear. that gives you a very clear roadmap. It also addresses a lot of the challenges which even Charanjit highlighted in terms of the transition which is happening on the technology side and how we as an economy should move in the right direction. So all that is being addressed. Everybody is probably now having a better idea about where I should be putting my money or capital, or which is in line with what we want to do for the economy and for the larger. In terms of implementation and resources, I would say there were a lot of questions about resources, but the kind of formalization of economy and the revenue collection which we have seen in this year, which is just coming out of a pandemic year, it is mind-boggling. Even after missing some of the important targets on disinvestment, I don't think we will be missing any of our fiscal deficit targets for this year. So that is the kind of rebound we have seen. That is the kind of tax revenue which has come in because of formalization of economy and other reforms. And all of this has been now directed in the right way. So that is also important, that you're not sitting on it, you're not trying to ponder it. I mean, we saw a large major bounty coming in the past, which was just spent on in the election. I mean, so that is the kind of risk run. But now with better planning and then the initiatives on Gati Shakti, where you want to coordinate, there are obviously big chances of delays which happen. And we know almost like 4-5 lakh crores of projects are stuck because of delays. But that is where these initiatives come in, where you have inter-ministerial coordination, you have the right top leadership coming in and addressing the issues if there are any in this Gati Shakti initiative. Just like if you have a smaller company and if some of these projects get stuck, but there's a coordination committee with the key heads of each department and the CEO to address it on a weekly basis or a monthly basis. I think that makes a lot of difference. That is where these initiatives come in. So I think it is much more better planning, much more clear roadmap. And I think if everybody falls into the same page, which being an economy which is more democratic, I think we should be expecting that there will be some issues here and there. But I think we are more confident this time that we will take 4 steps forward and maybe 1 step backward at some point of time. But we are probably on the right path, and government is very keen on getting things done this time.
Hi, my name is Archana. I have a question to the panel. Sir, as you said, data centers are now very important and automation is on pace and it's on high demand. As an investor, if I ask this question, that what percentage of my portfolio should be in investing in data centers? So what do you think? If I want to play it safe, I don't have much money to limited amount of money, but if I want to create a portfolio where the X percentage of should be the data centers, investment in data centers. So how should I go about it?
Charanjit, please address this query.
Yeah, sure. So first, before we get into the allocation part in terms of what percentage of your portfolio, see, you have to understand what goes into the data center. And data center as such is only one particular market segment. Data center it's a power guzzlers, okay? So they require power equipment, which is, like I told you earlier, 30% of the overall cost, 15% is automation cost, another 15% is cooling cost. So there are different players which will be addressing this opportunity. So when you are looking at an investment in any particular segment, what you have to look at is that the companies which can address not only data center opportunity, but other opportunities also. And why is that? Because data centers may continue for next 5-8 years, but then beyond that, how do you want the companies to grow? And these are again very competitive businesses where companies will be able to get the order. They may not be able to get the order. So what you try to do is you pick the best players in the industry, which can actually capture the larger part of the value chain. कि जो आपका 55% या 60% of the data center opportunity who can capture, you try to look at those companies. So that is how, when as a fund manager, I am trying to build my portfolio, I try to pick up companies which are able to address the larger pie within that cost structure of a data center, which have the technology also. Because companies are there who will say that, okay, they have the data center capability, but they may not have the technology, because again, technology is changing. A lot of these data centers are being set up also by international players. So what happens when international companies come and set up data centers in India? They require those global companies who have the capabilities and who have done the work for their global data centers to do the work also here in India. So that again gives a perspective that there are very few limited MNC companies which will have the exposure to these kind of, businesses. And that is where you can have, depending on your risk appetite, maybe 5% weight in terms of holding these companies to 7% weight in terms of holding these companies. But these are the companies which are not only addressing data centers, but multiple other opportunities. Always look at companies which are also diversified and which are able to capture one particular segment in a larger way. So that's the thought process which as an investor you should have on any opportunity. Does that answer your question, Archana?
Yes, yeah. Thank you, sir.
You're welcome.
Thanks, Charanjit. We have a question from Amar Purohit. Amar, can you please go ahead?
Yeah, good morning to everyone, and a very big thank you for all the information that you have been providing. My question to Charanjit and Sanjay is that we have normally seen in the past that when the economy picks up, the interest rates go up. The bank interest rates, the lending, and the deposit rates also might go up. When do we see this happening now? Maybe in the month of April onwards?
Sanjay, I request you to answer this question first.
Yeah, so if I understood the question right, you're looking at how rates can move up. And I think definitely we are behind the cycle in terms of lowering of rates. The inflation is now getting more focused, and most central bankers and the governments are very keen to limit the surplus liquidity, which had been there to support the economy to come out of a very sharp COVID-induced pandemic. But now, yes, the cost of funding will go up, and obviously for banks also the deposit and lending both rates will keep on moving up. But to our mind, this will not be a very sudden and sharp phenomena. It will be a gradual phenomena for now. Inflations are again going to be addressed because supply side issues can be sorted out. You would have a cooling off just after how the demand picks up when you have been shut for a long period of time. You did not have much to do, and then suddenly come and spend. But that's where you stop after a point of time, and then you normalize it. So all these factors will have an impact. If there is a very sharp and very severe jump in interest rate in a very short period of time, the only impact that I see on investment cycle is there will be a deferment. People will have to weigh things out of how these are going to impact your return on invested capital. And that is where there could be some pickup. But it's only possible if there is a very sharp rise in interest rates in a short period of time. So that is where you have to reassess your committed capital.
Thanks, Sanjay.
Yeah. Can I?
Yeah, please.
Yeah, firstly, let me thank you, Meksham, for arranging this session. Wonderful session. Thanks, Sanjay and Charanjit, for a good brief. I have one question. See, when we say infra, most of the times, as you mentioned, right, it is cement, railways, powers. Maybe now we briefly touched upon digitalization. Maybe it's an automation of the factory, and that came out as part of the COVID, impact, right? So people have realized and so on. So on the extension of this digital infra, I have a question. So there are a lot of, infra getting built around financial transactions. Let's say, what I mean by saying financial infra is around, UPI or IMPS or these kind of transaction infra getting built. And obviously, the byproduct of this, there are a lot of, apps coming up like Bharat Pay and Paytms of the world, or maybe, the infra around getting these payments done through various channels. Now, my question is, how, this kind of financial infra getting created, does it come under this theme of infra, or it is something, different, where, byproduct of financial inclusion of a lot of people by opening of account and so on? Do we consider that as part of infra, or it is out of that? Sorry, that's my, yeah.
Thanks, sir. It's a right question from a CTO of a bank. Charanjit would like to, basically you want to know whether banking is a part of this infrastructure or not.
Means banking as a service is now banking, or rather fintechs, right, as part of new financial, the way to deal with the financial these are new ways of doing transactions, right? Even opening of account now, it has become like, it's like take it as a Grow or any of these fintechs, new apps. There are new ways of transacting day to day, and banking has become like a service now. But of course, so my question is, does this financial infrastructure comes under infrastructure theme as per se, or it is still a different theme?
Charanjit, please request you to answer this question.
So I think, sorry, actually, can you hear me? Yeah. So I think that's a very interesting question, and we thought about that quite a lot. And I think Kamlesh ji has also put it very rightly, that the world is changing. And as these themes, when we are talking about infrastructure, digital infrastructure is also very important. I know my screen is not loading. Let me just stop this then. Okay. So see, financial platforms, we definitely see it as a part of digital infrastructure, which is building up in the economy right now. And what is happening is that as a country, we are just trying to build up this infra, and we are getting into that journey where UPI and all these financial platforms are now just coming up. So, and it will be depending on the construct of each individual fund in the infrastructure space. But Tiger Fund as such, we have taken a call where we are not including lenders, which are banks and NBFCs, but we are including financial platforms, because we see that digital infra, which is right now not being captured in any data points also in the economy, is going to be a very important factor in terms of how our economy progresses and how the transition happens to that digital infra. So financial platforms as such, to answer, definitely forms a part in terms of investing even in this infrastructure funds, because in a way they are trying to create an infrastructure which was not there in the earlier cycle. This is a new age infrastructure. This is digital infrastructure. This is going to be part of the economy and create much more value to that entire economic growth. We cannot miss out on financial platforms not being part of this theme. Otherwise, we'll not be able to capture that upside, like you're rightly saying. And we are always looking at how the world is changing. Can we integrate those themes into this fund and benefit from that big transitions which are happening? And fintech and digital platforms on the financial side are those platforms which cannot be missed out in terms of looking at from a digital infrastructure perspective. Yeah.
Thank you, Charanjit. Yeah, you have answered.
Sanjay, do you have this banking or a fintech in your portfolio as of now? And as Charanjit said, that if there are any such fintech or financial infrastructure coming in, then we will definitely consider that. So do you have any plans if you don't have any such allocation to your fund?
Yeah, so that's a valid question about how one looks at banking as a part of infrastructure. To an extent, you cannot have infrastructure creation without finance. So that is impossible. But to be very fair about it, when you look at an infrastructure theme product, you would look at financiers who are more dependent on this space rather than looking at pure retail lenders. So in that context, unless we have a proper financial institution which is dedicated for infrastructure financing, and there are a few which are there within the power space. There are a few which are being developed now, but they are not meaningful. And when we look at it from an investment perspective for our fund, it is not only the opportunity, but it is also the valuations and where we see relative better returns. Managing the risk associated with it, that is where it forms a part of our portfolio. So yes, digital infrastructure, as I highlighted in the initial remark about what comes in infrastructure as a theme, is one which is very big important area. It is not just linked to telecom. It has to be much wider ambit. And yes, it will be, as of now, our fund, the Nippon India Power and Infra Fund, doesn't have any financial institution name. But it is a matter of our opportunity, our return expectation, and the valuation that we look at it and how it fits into our portfolio. So that is where it will come in as and when we see the right opportunity to play the theme. So we have to be core to our theme. We cannot deviate from that. because at the end of it, the investor also has its own set of creating a portfolio. And if we try to confuse him with too many things across various products, then it loses the relevance of a thematic product.
Thanks, Sanjay. Anyone has any questions? We'll have last question because we've already crossed more than an hour. Anyone has any question?
I just have a simple question.
Yeah.
You know, they they covered a broad sweep of infrastructure. Almost all investments are either consumer-led or infrastructure-led. There are two known unknowns. One is the fact that land acquisition in India is still it's still a question mark, and the climate change impact on infrastructure. I mean, for example, just to give you a context, in Kerala, there is a huge debate going on whether there should be a north-south railway link, or there should be a road link, or it should all be covered by air. So, given these unknowns, and given the fact that, okay, I mean, you can kind of say that, yes, global commodity prices have gone up and bulk of the infrastructure will involve a fairly large quantum of imports because A, we don't have the capacity, B, we may not have the technology. And therefore, you can say, okay, a 14, 15-year period may not be easy enough to kind of forecast. How are these known unknowns and unknown unknowns being plugged in your overall DCF return and so on?
Sanjay, would you like to address this question? It's a little sensitive issue in terms of climate change and all. So just would like to have your perspective on this.
There were two key aspects to it. One is on the policy front and one is on the technology front, if I understood it right. So yes, on the policy front, there are clear laid out areas about land acquisition. And as Charanjit also mentioned, that most government projects are not allowed to be awarded unless you have 80% acquisition of the land itself. So you had some of these projects get delayed. All the large scale projects that we talk about, which involves more than one state, and there are land issues, like very famously the Mumbai Ahmedabad bullet train project, you have a lot of issues about the end leg, but so long as we did not have the 80% land, there were not enough orders coming in, but now we have seen that. So there is roadmap being laid out about land acquisition. Obviously for private players also, when you put out a capex, that forms a very significant part of your cost. But I think as a democratic setup, as I mentioned, we will have to evolve it in a more democratic fashion. And that is where we cannot go at the speed of China or other countries. We'll take 4 steps forward and maybe we'll have to pause somewhere and relook at our strategies. But that is part and parcel of investing in any form in any market. And that definitely gets addressed when we look at various companies in terms of how they manage their balance sheet risk, how they look at long-term strategy, what has been the track record, how have they addressed these issues in the past. All those form a part of our investment process. So we try to address this as much as possible. The climate part of it, again, most projects are not allowed to go ahead unless there's proper approvals in place. At least that is what the democratic setup gives you benefit. All the environmental analysis is done, the forest clearances are required. In fact, we as a country have moved significantly ahead on addressing some of the climate issues. Whether you look at automobile as a space, the kind of emission norms that we have, probably the global standards. In the diesel genset emissions, we are probably ahead of even some of the developed markets. So we are almost going to equivalent of Euro 6 in terms of vehicle emission. In diesel genset emission, we are already there. We have set up a roadmap of having more renewables. Obviously, it will have its own set of challenges, how you balance the grid, how you try to lower the cost at the same time. But that is how it is. So we have clearly defined, and it is a matter of journey. As far as technology risk and import question is concerned, I think we have enough capabilities and we are developing more capabilities. We are, as an economy, quite blessed to have engineering skill sets. You would be surprised to know that all the global MNCs have the largest R&D centers in India. Whether you take General Electric, whether you take Siemens, ABB, Honeywell, or any other company, you would have the large presence in India because of the engineering skill sets and because of the English as a language and IT skills. So it's a deadly combination if you look at it from a technology perspective and a transition perspective. They are benefiting on the global level by leveraging India's capability. I think as an economy, we should definitely leverage more of it. And I don't think that's a big issue. Initially, yes, some of the technology like hydrogen and all, you'll have to learn. It's an old chemistry, but to get it at a scale and the right cost, that is where you learn. But we have done enough reverse engineering, whether you take pharma or chemicals or auto. We are the global suppliers for almost every company in the world. Even on electric vehicles, we have started developing our own ecosystems. I think that it's a matter of learning, but we definitely have the demographic and skill sets to move up the chain.
Thank you so much, Sanjay. Thank you so much, Sanjay and Charanjit, for such a wonderful session. It was a really interactive session. Thanks for sharing your insights, your view, your thoughts on this sector. And I would like to thank all the participants. Thanks for being such a lovely audience. We'll stop here. If anyone has any questions, we request you to please mark it to your advisors. We'll then ask respectively to both Charanjit and Sanjay, and we'll pass on their reply to you. So we'll conclude here. Thank you so much once again. Have a great weekend ahead, and thank you so much, Sanjay and Charanjit, once again for taking out time and giving your perspective on this particular sectors. Thank you so much.
Thank you, Meg.
Thanks, everyone.
Have a great weekend. Thank you.
Yeah. Thank you. Bye-bye. Thanks, everyone.
Thank you. Thank you so much.
Thank you. Bye-bye.